Adam buys a rental property. Ryan puts the exact same amount of money into index funds. They both go to sleep that night, absolutely convinced they made the smarter choice. They're both wrong, because one of them forgot to count the hours, and the other forgot to count the zeros. This is not a video about which investment is better. This is a video about what actually happens when you run the real numbers, not the napkin math, not the YouTube thumbnail math, not the barbecue math, the actual, full-picture math over 20 years. And I promise you, by the time we get to year 20, at least one number in this video is going to genuinely surprise you. I'm Professor Wealth, and this is the real math. Before we run a single number, let's make sure this comparison is completely fair, because the moment one person has an advantage over the other, the whole exercise falls apart. So here are the rules. Adam and Ryan are the same age. Let's say 30 years old, they live in the same city. They both earn $55,000 a year, and they've both managed to save $50,000. Same starting line, same resources, same opportunity. The only difference, what they decide to do with that $50,000. Adam has been watching real estate videos for 6 months. He's convinced that rental property is the proven path to wealth. His uncle owns 3 properties and drives a nice car. Adam wants in. Ryan has been reading about index fund investing. He's heard that Warren Buffett himself recommends low-cost index funds for most people. Ryan decides that's good enough for him. Both of them are about to make a decision. Both of them think they're right, and both of them are about to spend the next 20 years finding out. Let's start with Adam. Adam takes his $50,000 and uses it as a 20% down payment on a $250,000 rental property. It's a modest 3-bedroom house in a decent neighborhood. Not fancy, but solid. Good school district. Low vacancy area. Adam did his homework. He takes out a 30-year mortgage at 7% interest. His monthly mortgage payment comes out to approximately $1,530 per month. He finds a tenant pretty quickly, someone willing to pay $800 a month in rent. Now let's do the math Adam does in his head. $500 in rent minus $330 mortgage payment equals $470 a month in profit. $470 times 12 months equals $5,640 a year. $5,640 divided by his $50,000 investment equals an 11.3% annual return. Adam feels like an absolute genius. He's getting an 11% return and building equity and getting tax benefits. And his property is appreciating. He tells his friends at dinner. They're impressed. He drives past the house on the way to work and thinks, I own that. Everything about this investment feels real, tangible, smart. And on paper it is. The problem is that we're not living on paper. Ryan takes his $50,000 and deposits it into a total stock market index fund. Specifically, he buys VTI, the Vanguard Total Stock Market ETF. This single fund gives him ownership in over 3,500 companies across the entire U.S. economy. He also sets up an automatic contribution of $300 every single month. It comes out of his paycheck before he even sees it. Then he closes his laptop, and he doesn't think about it again. His co-workers ask him what he's investing in at lunch one day. He says, index funds. They nod politely. Someone changes the subject to the game last night. Nobody's impressed. There's no story here, no keys to hold up, no property to drive past, no tenant to brag about. Ryan has a brokerage account and a confirmation email. That's it. On day 1 of this 20-year experiment, Adam has a house, a tenant, monthly cash flow, tax benefits, and a great story for dinner parties. Ryan has a number on a screen. In terms of how it feels, it's not even close. Adam is winning. But feelings and math are 2 completely different things. And we are here for the math. Let's track what actually happens in the first 3 years. For Adam, the first year feels like everything he imagined. Rent checks arrive every month. He's claiming mortgage interest on his taxes. That's roughly $17,000 in deductions in year 1 alone. He's also depreciating the building. That saves him another $3,000 to $4,000 in taxable income. His property appreciates about 3.5%. And is now worth roughly $259,000. His equity has grown from $50,000 to about $61,000. On the surface, Adam is absolutely winning. For Ryan, year one looks boring. His $50,000 grows to about $55,000. He gets a statement in the mail showing he now owns fractional shares of Apple, Microsoft, Amazon, Google, and 3,196 other companies. He doesn't feel wealthy. He just sees a slightly bigger number on a screen. Year two. Adam raises rent slightly to $1,850. Still collecting, still feeling good. Ryan's portfolio is now around $61,000. Still boring. Still nothing to show anyone. Year three is when the first crack appears for Adam. Let's run the real numbers for Adam through 3 years. Total rent collected, $64,800. Total mortgage payments, $47,880. Gross cash flow, $16,920. Sounds great, right? Now let's subtract the real costs. Property taxes, $3,000 per year times 3 years equals $9,000. Insurance, any $500 per year times 3 years equals $4,500. Water heater replacement on $200. Leaking roof repair, $2,800. 1 month vacancy, $1,800 in lost rent plus $600 to clean and relist. Miscellaneous repairs and maintenance, approximately $2,400. Total real costs beyond mortgage, $22,300. Adam's actual net cash flow after 3 years of being a landlord, somewhere between $2,000 and $4,000. Not $16,920, $2,000 to $4,000. Over 3 years. And that number does not include a single hour of Adam's time, not the late-night phone calls, not the weekend repair coordination, not the tenant screening, not the showing appointments. If Adam valued his time at even $20 an hour, and his time is worth more than that, he's likely broken even or lost money in the first 3 years. Ryan, meanwhile, has $76,000 in his portfolio. He spent 0 hours managing it, 0 phone calls, 0 emergencies, 0 weekends lost. But here is the one thing Adam has that Ryan absolutely does not: leverage. Adam's $250,000 property has appreciated 3 to 4% per year and is now worth approximately $275,000. His remaining mortgage balance is about $237,000. That means his equity, the portion he actually owns, is roughly $38,000 on top of his original $50,000. Total equity, approximately $88,000. Adam used $50,000 to control a $250,000 asset. Ryan used $50,000 to control $50,000 in assets. That 5-to-1 leverage ratio is real, and it's powerful. And it's the single biggest financial advantage real estate has over stock investing. Before we get to year 5, I need to stop and talk about the numbers that never show up on the YouTube thumbnail. The rent check number, $1,800, that's the number everyone sees. That's the number at the real estate meetup. That's the number Adam's landlord buddy brags about. That's the number that makes rental property look like a no-brainer. What nobody talks about is everything that comes out of that rent check before you actually keep any of it. Number 1, vacancy. The average rental property sits empty for approximately 1 month per year. That doesn't sound like much. But that's 1 full mortgage payment, fine $330, with 0 income coming in to cover it. And when a tenant leaves, you're also paying for professional cleaning, minor touch-up repairs, listing fees, and your own time to screen applicants and show the unit. A single tenant turnover can easily cost $2,000 to $4,000 all in. Number 2, maintenance and repairs. The industry standard is to budget 1% to 2% of the property's value per year for maintenance. On a $250,000 house, that's $2,500 to $5,000 every single year. Some years it's a $200 faucet fix. Other years it's a $7,000 HVAC replacement that you didn't see coming and absolutely cannot postpone, because it's August and your tenant is threatening to call the housing authority. Number 3, capital expenditures. This is the one most landlords forget to budget for. Roofs last 20 to 25 years. Replacement cost $8,000 to $15,000. Furnaces last 15 to 20 years. Replacement cost $3,000 to $6,000. Water heaters last 10 to 12 years. Replacement cost $800 to $1,500. These are not surprise expenses. They are guaranteed future expenses. If you are not setting aside money every single month for these, you are not running an investment. You are running on luck. Number 4, property management. If Adam hires a property manager, that's 8% to 10% of monthly rent gone immediately. On $1,800 rent, that's $144 to $180 a month, or roughly $1,800 to $2,160 per year, just for someone else to handle the phone calls. If Adam manages it himself to save money, he's essentially working a part-time job that pays him nothing extra. His time has a cost even if nobody writes him a check for it. And number 5, the one risk nobody in real estate loves to discuss. Bad tenants. A tenant who understands the eviction process can stay in your property for 3 to 6 months without paying rent while the legal process plays out. In some cities, it's even longer. Legal fees, lost rent, property damage, a single bad tenant experience can erase an entire year of profits, sometimes more. None of these costs appear in the $470 a month cash flow calculation, but every single one of them shows up eventually. By year 5, Adam is no longer the excited new landlord. He's now a seasoned one, and seasoned means battle-tested. He's on his 3rd tenant. First tenant left after 18 months, normal turnover. Second tenant caused $3,200 in damages beyond the security deposit. Third tenant seems solid, but Adam learned his lesson and now does a much more thorough screening process. He's replaced the roof, $8,500, dealt with a plumbing emergency of $400, had 2 months of vacancy in 5 years, $3,600 in lost rent plus turnover costs. He's raised rent to $1,950, which helps, but his property taxes and insurance have both increased as well, eating most of that increase. His actual cash-on-cash return, the real money he pockets relative to the money he put in, is hovering around 3% to 5% after all real expenses. 3% to 5%. That's not the number he told his friends about at the barbecue. But here's the important flip side. His property is now worth approximately $297,000. His remaining mortgage balance is about $227,000. His equity is now roughly $70,000, and he owns an appreciating asset with leverage. That part is very real. Ryan at year 5 is still doing absolutely nothing. His portfolio has grown from $50,000 to approximately $105,000 to $115,000, including his $300 monthly contributions. He's added $18,000 in contributions. The rest, nearly $40,000, is pure market growth. By year 7, something interesting starts to happen in Ryan's portfolio. The compound growth is beginning to accelerate. In year 1, Ryan's portfolio grew by maybe $5,000. In year 7, his portfolio grew by approximately $12,000 to $14,000 in a single year. Same percentage return, but the base is now much larger. The gains on his gains are now generating more new wealth each year than his original monthly contributions. This is the part of compound interest that feels slow for the first 5 years, and then suddenly feels like someone turned on a rocket engine. Year 10. This is where the story gets genuinely interesting. Adam's property is now worth approximately $335,000 to $350,000. His remaining mortgage balance is about $215,000. That gives him equity of roughly $120,000 to $135,000. On top of his original $50,000 investment, he's also put in approximately $25,000 to $35,000 in additional costs beyond mortgage over 10 years. Repairs, vacancy, capex, taxes, insurance. Total money Adam has put into this investment, approximately $75,000 to $85,000. Total equity, Adam has built approximately $120,000 to $135,000. Net gain, roughly $40,000 to $60,000 over 10 years. Plus, he's had the appreciation on the full $250,000 asset, not just his $50,000 down payment. That leverage effect has been real and significant. Ryan's portfolio at year 10, with consistent $300 monthly contributions and approximately 10% average annual returns, is sitting at approximately $165,000 to $180,000. He has put in $50,000 plus $36,000 in contributions, $86,000 total. His portfolio is worth $165,000 to $180,000. Net gain roughly $80,000 to $95,000 over 10 years. Wait, let me say that again. Adam put in more money, spent hundreds of hours managing his property, took on $200,000 in debt, concentrated his entire investment in a single asset in a single zip code, and his net gain after 10 years is approximately $40,000 to $60,000. Ryan put in less money, spent 0 hours, took on 0 debt, diversified across thousands of companies, and his net gain after 10 years is approximately $80,000 to $95,000. High pure return on investment, Ryan is ahead at year 10. But, and this is a critical but, Adam owns an asset worth $335,000 to $350,000. His total wealth, including the property value, is significantly higher than his equity number alone suggests. At year 10, when you look at total net worth, they are actually surprisingly close. Adam, approximately $120,000 to $135,000 in equity. Ryan to approximately $165,000 to $180,000 in portfolio value. Ryan is ahead, but not by the massive margin you might expect. The leverage that hurt Adam's cash returns has been quietly building his net worth the entire time. Year 20. This is where we find out what 20 years of decisions actually built. Adam's property is now worth approximately $450,000 to $500,000. His mortgage is either completely paid off or within a few years of being paid off. His equity is somewhere between $400,000 and $500,000, depending on his specific market appreciation. He's been collecting rent for 20 years. He's also been paying expenses for 20 years. After 2 decades of maintenance, repairs, tenant turnover, property taxes, insurance, vacancy, and at least 1 major renovation, his total net cash flow profit above and beyond all expenses is approximately $40,000 to $80,000. Maybe more in a hot market, maybe significantly less in a flat one. But he owns a property worth $450,000 to $500,000 with little to no mortgage remaining. That is genuinely significant wealth. Ryan's portfolio at year 20, with $300 monthly contributions and 10% average annual returns, has grown to approximately $420,000 to $460,000. He put in $50,000 originally plus $72,000 in contributions over 20 years. $122,000 total from his own pocket. His portfolio is worth $420,000 to $460,000. That means approximately $300,000 of his wealth was created by compound growth alone. Not by working, not by managing anything, simply by owning a piece of the US economy for 20 years and not touching it. When you compare total net worth at year 20, Adam and Ryan are in the same ballpark, both somewhere between $400,000 and $500,000. But here is where it gets really interesting. Adam worked for his. Every single dollar of Adam's wealth required attention, decisions, repairs, phone calls, tenant relationships, legal knowledge, and time. It is real wealth. But it came at a real cost. Ryan waited for his. Ryan's wealth required exactly one decision, made once, at age 30. Everything after that was compound interest doing the work while Ryan slept. Same destination, completely different journey. Now I want to be completely honest with you. If I only showed you the downsides of real estate, I'd be doing exactly what every stock market influencer does, cherry-picking data to support a conclusion I already made. Index fund investing has very real risks that people love to gloss over. Volatility is brutal. In 2008, the market dropped approximately 37% in a single year. In March 2020, it dropped 34% in literally 1 month. If Ryan had $200,000 in his portfolio and watched it fall to $130,000 in a few weeks, that is not a number on a screen. That is gut-wrenching. It feels like losing $70,000 even though you haven't sold a single share. And the data is absolutely clear on this. Most retail investors do not stay calm during crashes. They panic sell near the bottom, lock in real losses, and then buy back in after the recovery has already happened, turning a temporary paper loss into a permanent real one. There's also no cash flow. Real estate sends Adam a check every month. Index funds don't send Ryan anything he can spend. Dividends exist, but on a total market fund, you're looking at maybe 1.5% to 2% yield. On a $200,000 portfolio, that's about $250 to $300 a month. That's not replacing anyone's income, and there's no leverage. Ryan used $50,000 to control $50,000 in assets. Adam used $50,000 to control $250,000 in assets. That 5-to-1 leverage is the main reason real estate has created more millionaires than the stock market in many wealth surveys. Index funds are powerful, but they are not magic, and pretending otherwise is dishonest. Real estate is not a bad investment. It is a widely misunderstood one, and there are specific situations where real estate absolutely crushes index fund investing. Situation 1. Strong rent-to-price ratio markets. If monthly rent is at least 0.8% to 1% of the purchase price, the cash flow math works strongly in your favor from day one. On a $250,000 property, that means finding a tenant who pays $2,000 to $20,500 per month. In some markets, that's realistic. In others, it's impossible. Know your market before you buy. Situation 2. House hacking. Buy a duplex or small multi-unit property. Live in one unit, rent the others. Your tenants pay your mortgage. Your housing cost drops to near zero or sometimes literally zero. You're building equity while living for free. This is one of the most powerful wealth-building strategies available to someone in their 20s or 30s, and the stock market simply cannot replicate it. Situation 3. The 1031 exchange. When you sell a property and reinvest the proceeds into another property within specific time limits, you defer capital gains taxes completely. You can repeat this process for decades, rolling your profits from property to property to property, growing your portfolio tax-deferred in ways stock investors cannot replicate outside of retirement accounts. Situation 4. Depreciation. Real estate investors can deduct the theoretical decline in their building's value from their taxable income every year, even when the property is actually appreciating in value. That is a legal tax shelter that stock investors simply do not have access to. Real estate wins when you treat it like a business, not a side hustle. When you know your numbers before you buy, when you budget for every real cost, when you have reserves for capital expenditures, when you screen tenants carefully, when you have systems. When you do all of that, real estate can absolutely outperform index funds, especially with leverage. So what's the conclusion? Which one wins? Here's my honest answer. Neither one automatically wins, and neither one automatically loses. Adam and Ryan both walked away from their initial decision completely convinced they were right. Adam thought real estate was the proven path. Ryan thought the market would do the work for him. Neither of them actually sat down and mapped out what their choice would cost. In dollars, in time, in stress, in risk, and in opportunity cost, over 20 years. The real trap is not real estate. The real trap is not stocks. The real trap is making a financial decision worth hundreds of thousands of dollars based on a YouTube headline, based on a podcast clip, based on something your uncle said at Thanksgiving, based on what feels impressive at a dinner party, without ever running the full numbers. The person who wins in this comparison is not Adam. It's not Ryan. The person who wins is the one who actually understands what they're buying before they buy it, who counts every cost, who factors in their own time, who knows their market, who has a plan for the bad years, not just the good ones. That person can make either strategy work. And if you're wondering what happens when you do both, when you own property and invest in the market at the same time, that is a completely different conversation. And the math might change everything you think you know about building wealth. But that's a video for next week. For now, the next time someone tells you real estate always wins or the stock market always wins, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video gave you something useful, drop the word math in the comments. I read every single one and I'll like every comment I see. Subscribe to Wealth Logic. We post every Tuesday and Friday. We run the numbers on the financial decisions everyone